Welcome back to the Douglas D. White Financial Services Tip of the Day. This is part 2 of life insurance. There are 3 different types of life insurance that you may be interested in. The first type of life insurance is term insurance. The second type of life insurance is whole life insurance. And the last one is universal life insurance, and that can either be fixed or variable. Let's talk about term insurance first. Term insurance, you specifically decide how much coverage you need, say $100,000, how long you want to be covered, 10 years, 15 years, 30 years, and you are covered during that period of time. In order for the death benefit to be paid to your beneficiary, you must die during the period that you selected. If you selected a 10-year period of time and you die in year 11, your beneficiary won't get paid. If you selected a 15-year term and you died in the first year, your beneficiary will get paid. The 14th year, your beneficiary will get paid. The 16th year, no payment for your beneficiary. And it goes on from there. 30 year, 40 year, you have to die during the time you're covered. Whole life is different. Doesn't matter when you die. It's coverage for your whole life. If you die the day after you take out the policy, your family gets the money. If you die at 65 years old, family gets the money. If you die at 199 years old, the family gets the money. Another thing about whole life insurance is it builds cash value and dividends. That can be taken by the insured as money or cash out. Talk to your financial professional before you cash out and find out what that does to the policy. It can reduce the death benefit, it can reduce the cash value, it can reduce future dividends. There are a lot of questions you want to discuss with your financial advisor if you're going to use the cash from your whole life policy. The third type is universal life. Universal life can either be invested in guaranteed instruments such as treasury bills, or it can be in the stock market, in sub-accounts which work like mutual funds. The rate of return is based on the performance of the treasury bill or of the sub-accounts. You can make money in it. It does cover you for as long as you want it to cover you for. It could be your whole life, or it could just be for a specific period of time. You would determine that with your financial professional. How long you want to be covered, for how much you want to be covered, and if you want the policy to actually build cash value, or you just want the policy to run with a minimal amount of cash value to keep the cost lower. Remember, the more death benefit you select, the more the policy will cost. The longer you want to be covered for, the more the policy will cost. Short-term term insurance is the cheapest. Whole life is the most expensive. Universal life seeks to be more cost-effective and give you control over how long you would like to be covered and for what amount of cash value buildup you would like to achieve. As always, if you have more questions, contact me or your financial professional. I've enjoyed your feedback. Keep it coming. You can also look up different terms about life insurance on my website, www.douglasdwhite.com. Good talking to you, and hope to see you on the next tip.